All right, well, let's talk about the fact that investors are still looking ahead to key economic data out this week, including tomorrow's inflation report. We also had the Fed decision coming on Wednesday. Our next guest saying that the November rally left, quote, widespread overbought conditions in the S&P 500, but he is also warning that history suggests that short-term pain could be ahead for the markets before long-term gains. Let's break it all down with Adam Turnquist. He is LPL Financial's chief technical strategist. Joining us now, it's great to see you here. So some short-term pain. You are, though it sounds a bit optimistic about the longer term, but what does this mean then for investors and their positioning going into the new year?
I think it really means there's potential here for a little bit of a pullback, as you mentioned, maybe some short-term pain before we see those long-term gains. The narrative in the market has really changed. You outlined how we're now talking about interest rate cuts instead of interest rate hikes. The market's gone from a correction to a comeback, had a huge November rally, very bullish. Just because we'll see some short-term pain does not mean that's a bearish call. But when you look at the underlying composition of the market, we had broad-based buying in November, a sizable almost 9% rally in the S&P 500. And what that did, it created very overbought conditions historically. So we had about a third of the S&P 500 actually reach overbought conditions based on a momentum indicator that we like to look at. Now, that's extremely rare when you go back to 1990. That's only occurred less than 1% of the time. And if you look at the forward returns during those prior periods, the market typically is, we'll call it flat over the next 1 to 3 months. However, going to the longer term, and I think that's where investors should be focused, 12 months later, the average return during those periods, just over 12%. Only one had a negative return as well. So we do think there's a pretty good positive read-through as we look ahead to 2024 based on that data.
Adam, when you hear calls on the street pulling forward some of their estimations for a cut in Fed policy, does that signal to you that we're perhaps more imminent to a mild or shallow or mild recession, depending upon which camp you're in at the end of the day? Because that would perhaps suggest that the Fed sees something so dire that it actually needs to cut.
That's really the key question, I think, because we've seen rates come lower. We've seen Fed rate cuts get pulled forward to March, right around 40%. And we have to ask ourselves, why are we seeing rates move lower and why are we pricing in interest rate cuts? Is it because a recession is more imminent than expectations, or is it a victory lap on inflation? I think we'll get a pretty good read through from the Fed this week at their December meeting, and we'll get the updated summary of economic projections. I think right now, though, the market's giving the economy the benefit of the doubt of a soft landing scenario. We're kind of in this Goldilocks scenario, and for now that seems to be okay for the market and for this rally that we're seeing.